Thanks for joining me this Friday, the 9th of August. I'm Grady Wolf, market analyst at Bell Direct, and this is the second video for Bell Direct's reporting season coverage this August 2024 and is our weekly market wrap. So far this reporting season, only 12 companies have reported, with 4 beating expectations, 4 missing expectations and 4 meeting expectations this earnings season. Higher costs eating into margins and an uncertain outlook for FY25 were key trends emerging in the reports released this week that had investors reaching for the sell button on key ASX-listed companies. Transurban ASX TCL shares fell on Thursday after the toll road operator released FY24 results. Despite a strong year in FY24, investors analysed key areas of concern, which prompted the decline in the TCL share price yesterday. For FY24, Transurban reported proportional toll revenue rose 6.7%, while total revenue fell slightly compared to FY23. FY24 profit more than quadrupled to $376 million, thanks to lower construction and finance costs. TCL also increased its dividend by 7% to 62 cents per share. Investors overlooked these positive results, though, amid concerns over the company's high debt level increasing in FY24 to $25.868 billion from $24 billion in FY23, and over the outlook for government reform in toll roads to help relieve drivers of the high expense over FY25, which could hurt earnings for Transurban. The retailers were anticipated to face strong headwinds this reporting season, and this trend has certainly prevailed, with shares in Myer, the department store giant, diving over 7% on Thursday following the release of a trading update. Amid a reduced customer spend environment creating headwinds for companies like Myer, the department store giant reported expected total sales for FY24 to be $3.266 billion, down 2.9% on FY23. FY24 expected NPAT is between $50 million and $54 million, down from the $71.1 million in FY23 due to underperformance, store closures and inflationary pressures and consistent inventory. The company outlined it is undertaking tight cost management processes and fully leveraging its Myer One loyalty program in a bid to boost sales. However, the outlook for retail spend continues to drive investor sentiment around earnings depreciation for the retail space. On the upside for Myer, though, the company is continuing to consider the takeover proposal of retailer Premier Investments apparel business. And Mirvac ASX MGR fell victim to the high cost environment of FY24, which had investors selling out on Thursday, which saw the Australian property developers' share price tumble 9% in just one session. Mirvac's FY24 saw many metrics fall on FY23, including operating profit after tax down 5% to $552 million, operating earnings per share down 5% to 14 cents per share, statutory loss of $805 million, down from the FY24 statutory net loss of $165 million, and the dividend remained flat at 10.5 cents per share. Higher costs across the company's apartments projects in New South Wales are expected to continue into FY25, with Queensland apartment projects also expected to be affected, which paints a tough cost headwind to remain into the new financial year, which also has flow-on effects in depleting margins below Mirvac's target of 18% to 22% range. In terms of outlook, Mirvac outlined the expectation of operating earnings to fall to between 12 cents per share to 12.3 cents per share from 14 cents per share in FY24, and distribution of 9 cents per share, down from the 10.5 cents per share paid in FY23 and FY24. The reason for the weaker outlook is due to expected impact of lower contribution from Mirvac's development business and higher net interest costs related to the development activities. And that's a wrap on week 1 of reporting season. As was predicted, the earnings outlook for FY25 is weaker across most sectors, given the high cost environment, subdued demand and impacts of higher debt levels on cost appreciation. Locally, from Monday to Thursday, the ASX 200 fell 3.29% as a heavy sell-off on Monday offset the gains experienced later in the week. Every sector posted a loss over the 4 trading days. The winning stocks on the ASX 200 this week were led by AMP, rising 8% on FY24 results, while Pilbara Minerals added 4.2% and Domino's Pizza rallied 3.25%. On the losing end, Ordinate Group fell 38% on FY24 results. On the broader market, the All Ords fell 3.47% this week as Bowen Coking Coal fell 35%, while Atlantic Lithium lost 20%, and Meteoric Resources ended the 4 trading days down 19%. The most traded stocks by Bell Direct clients over the 4 trading days were CBA and ANZ. Clients also bought into Woodside, BHP and Westpac, while taking profits from NAB, Origin Energy, Woolworths, Macquarie and Wesfarmers. And the most traded ETFs this week were BetaShares Nasdaq 100 ETF, Australian Equities Strong Bear Hedge Fund ETF and iShares S&P 500 AUD ETF. On the economic calendar next week, we can expect to see markets respond to Westpac consumer confidence data out in Australia on Tuesday, with the expectation of a slight rise in consumer confidence for August. Overseas, key US inflation data is out on Wednesday, with the forecast of a slight rise in inflation rate month on month, but the overall inflation rate to remain year on year at 3%. Any rise in inflation will likely lead to further sell-off in equities on Wall Street, as investors' sentiment is already dampened by rising recession fears in the US. US retail sales and PPI data are also out next week, with the expectation of a fall in both areas in the month of July. And on the reporting season calendar next week, we can expect results from JB Hi-Fi, Cochlear, CSL, CBA, James Hardie Industries and Goodman Group. And that's all we have time for. Have a wonderful Friday, a great weekend and happy investing.